Welcome and let us get started. Today we are going to break down how to analyze chart patterns step by step. Whether you are brand new to trading or you already have some experience, understanding chart patterns is a game changer. These are powerful tools that can help you predict market trends and make better decisions. By the time we are done here, you will know how to analyze these patterns with confidence. So stay with me and let us dive right in. Before we dive into the details, let us ask ourselves this: how can understanding chart patterns help us take control of our trading journey? Think about this. Every price movement leaves behind a story, and chart patterns are the language of that story. So, what exactly is a chart pattern, and why does it matter so much? Let us start with the basics. A chart pattern is a shape or formation that appears on a price chart. These patterns are created by the movement of prices over time, and traders use them to predict where the price might go next. When you learn to recognize and analyze these patterns, it is like gaining a new lens that helps you spot the right opportunities to enter or exit a trade. It gives you an edge in the market and can be a real game changer for your trading success. The first key step in this process is recognizing the pattern itself, and that is what we will begin with. The first step in analyzing chart patterns is to identify the most common ones. There are several key patterns you will see repeatedly, and each tells a unique story. Examples include head and shoulders, double tops and bottoms, triangles, rectangles, flags, pennants, and wedges. Let us explore a few of these in more detail. The head and shoulders pattern is a well-known reversal pattern. It typically signals the end of an uptrend and the start of a downtrend. A similar reversal pattern is the double top, which shows two peaks at a similar price level before a significant drop. Conversely, a double bottom occurs after a downtrend, indicating that the price may reverse to start moving upward. Continuation patterns are also crucial to understand. Triangles are one of the most common continuation patterns, and they come in three forms: ascending, descending, and symmetrical. Ascending triangles generally indicate that the price is likely to break upward, while descending triangles suggest a downward breakout. Symmetrical triangles can break in either direction, and traders look for a breakout confirmed by volume. Flags and pennants are also continuation patterns that indicate a brief pause in the trend before it resumes, giving traders a chance to jump in and ride the trend further. A flag pattern has a rectangular shape that slopes against the prevailing trend, resembling a flag on a pole. This formation generally occurs after a sharp price movement and is characterized by a period of consolidation that slopes slightly against the initial trend. The breakout from the flag pattern typically signals the continuation of the prior trend with renewed momentum. Pennants, on the other hand, have a small triangular shape that forms after a steep price movement, similar to a flag but with converging trend lines. Pennants differ from flags in that the price action forms a tighter consolidation, often resulting in a series of lower highs and higher lows that create the triangular shape. Like flags, a breakout from a pennant pattern usually suggests that the price will continue in the direction of the preceding trend. The key to effectively trading flags and pennants is to watch for strong volume accompanying the breakout. This confirms that the market is likely to continue in the direction of the trend. When trading a flag or pennant, it is important to identify the flagpole, which is the initial sharp price move leading into the consolidation. The length of the flagpole can often be used to estimate the potential price target after the breakout, giving traders a clearer idea of how far the price might move once the pattern resolves. Being thorough in analyzing both the flag or pennant shape and the accompanying volume will help ensure that the breakout is genuine and has a higher probability of success. Wedges are another important formation to watch for, and they can be powerful signals of potential reversals. Wedges come in two forms, falling wedges and rising wedges, each with its own implications for price movement. A falling wedge generally indicates a bullish reversal, especially when it forms after a significant downtrend. This pattern consists of two downward-sloping trend lines that converge as the price moves lower. Despite the falling price, the downward momentum starts to weaken, and the price action becomes more compressed. This compression often signals that selling pressure is decreasing, and buyers may soon take control, leading to a breakout to the upside. The bullish breakout is often confirmed with increased volume, which adds reliability to the signal. Falling wedges can also occur as a continuation pattern within an uptrend, indicating a pause before the trend resumes upward. Rising wedges, on the other hand, suggest a bearish reversal, typically after an uptrend. In a rising wedge, the price makes higher highs and higher lows, but the distance between these highs and lows starts to narrow, indicating weakening upward momentum. The two upward-sloping trend lines converge as the price rises, showing that buying enthusiasm is starting to fade. When the price eventually breaks below the lower trend line, especially with increased volume, it suggests that sellers are gaining control and a downtrend may follow. Similar to falling wedges, rising wedges can sometimes act as continuation patterns in a downtrend, representing a temporary retracement before the downtrend resumes. The key to trading wedges effectively is patience and confirmation. Traders should wait for the price to break out of the wedge pattern before taking a position. For falling wedges, a breakout above the upper trend line, confirmed with strong volume, signals a buying opportunity. For rising wedges, a breakout below the lower trend line, also confirmed by volume, signals a selling opportunity. Properly analyzing the wedge pattern in the context of the overall trend and confirming the breakout with volume can significantly improve your chances of success. By understanding these common chart patterns and the story each one tells, you can make better decisions about where the price is likely to go next. Remember, not all patterns indicate the same outcome. Reversal patterns signal a change in trend, while continuation patterns show that the current trend is likely to persist. Recognizing which type of pattern you are dealing with is the first key to making informed trading decisions. One thing to always remember is to be patient. Patterns can take time to fully form, and patience is key to ensuring the accuracy of your trades. It is really important to wait until the pattern is clear and fully confirmed before making any moves. Many times, traders make the mistake of jumping in too soon, which can lead to false signals and costly mistakes. Waiting for the pattern to complete allows you to see the full picture, reducing the risk of making impulsive decisions based on incomplete information. Remember, successful trading is about stacking the odds in your favor, and patience is one of the best tools you have to do that. Let us be patient, let the pattern complete, and then make our move with confidence. Now, after you identify the pattern, you need to look at the trend that was in place before the pattern started to form. Is the market trending up, down, or sideways? This is important because it helps us understand what the pattern could mean. For example, if you see a head and shoulders pattern at the top of an uptrend, it usually means the trend is about to reverse. On the other hand, if you see that same head and shoulders pattern during a downtrend, it might mean the current trend will continue. Always remember to analyze chart patterns in the context of the overall trend. Doing this helps you know what to expect and make better decisions. The next thing you need to do is confirm the pattern using volume. Volume is how many people are buying or selling that stock at a given time. It is a really important part of confirming a chart pattern. If there is not enough volume, the pattern may not be reliable. High volume means that lots of people are trading that stock, which makes the move stronger and more likely to be real. For instance, when the price breaks out of a triangle pattern and there is a spike in volume, this means the breakout is likely real and not just a false signal. But if the volume is low, be careful. The move might not have enough momentum to continue. Also, pay attention to volume divergences. If the volume does not match the pattern, it could be a warning sign of a potential reversal or weakening trend. For example, if the price is going up but the volume is going down, this could mean that the move is losing strength and might not hold, signaling a possible exhaustion of buyers. Conversely, if the price is falling but the volume is also decreasing, it might mean that the sellers are losing momentum and a reversal to the upside could be possible. Always make sure that the volume aligns with the price movement to confirm the strength of the trend. Paying close attention to these divergences can help you avoid false signals and make better informed decisions. Now that the pattern is confirmed, let us talk about how to decide when to enter and exit the trade. For continuation patterns, like flags or triangles, you usually want to enter the trade when the price breaks out of the pattern. For reversal patterns, like head and shoulders, you would enter the trade when the price breaks below a key support level, which is often called the neckline. Setting your profit target is also very important. Let us take the head and shoulders pattern as an example. To figure out how far the price might move after the breakout, you can measure the distance from the head to the neckline. This is a good way to estimate where to set your profit target. And do not forget to set a stop loss. This is your safety net in case things do not go as planned. A good place to set a stop loss is just beyond the support or resistance level of the pattern. This helps you stay protected and avoid getting stopped out too early by regular market fluctuations. Another great tool to use when analyzing chart patterns is technical indicators. Chart patterns tell you a lot, but adding technical indicators to your analysis can give you even more confidence. One helpful indicator is the moving average. Moving averages help confirm trends. For instance, if the 50-day moving average crosses below the 200-day moving average after you spot a double top pattern, it can strengthen the idea that the price might go down. Another useful indicator is the relative strength index. This indicator measures the speed and change of price movements and tells you if a stock is overbought or oversold. The relative strength index ranges from 0 to 100, with readings above 70 indicating overbought conditions and readings below 30 indicating oversold conditions. If a reversal pattern forms while the relative strength index shows that the stock is overbought, it is another clue that a drop might be coming soon. On the other hand, if the relative strength index is showing oversold conditions during a reversal pattern, it could indicate a potential rise in price. You can also use Bollinger Bands, which are another valuable tool for understanding market movements. Bollinger Bands consist of 3 lines, a middle band, which is a simple moving average, and 2 outer bands that are standard deviations away from the middle band. These bands show when a price move is significant by displaying levels of high and low volatility. When the price breaks out of a pattern and also moves outside the Bollinger Bands, it is often a sign that there is strong momentum in that direction. A breakout above the upper Bollinger Band can signal strong bullish momentum, while a breakout below the lower band can indicate strong bearish momentum. Additionally, when the bands are narrowing, it suggests that a breakout is likely imminent due to decreasing volatility. Understanding how to interpret Bollinger Bands helps you get a clearer picture of the potential strength and direction of a price move. Now that you have a good idea of how to analyze chart patterns, let us talk about some common mistakes that traders make. One mistake is ignoring the larger context of the market. It is easy to focus on just the pattern, but you have to keep the bigger picture in mind. Always consider the overall market trend before you enter a trade. Another mistake is acting too soon. A lot of traders get excited when they think they have found a pattern and jump in before it is fully formed or confirmed. This can lead to false signals and losses because the pattern may not complete or could change direction unexpectedly. To avoid this mistake, always remember that patience is crucial. It is important to let the pattern fully form and wait for a clear breakout or breakdown with confirmation. Use additional tools like volume spikes or technical indicators to validate the move. Waiting for confirmation may mean missing the very beginning of the move, but it greatly increases your chances of a successful trade. Being cautious and disciplined in waiting for confirmation before acting can help you avoid costly errors and improve your trading results. Finally, many traders forget to set stop losses. Even the best-looking pattern can fail, and the market can move against you. Setting a stop loss is really important for protecting your money if things do not go as planned. Always set a stop loss to keep your risks under control. Let us go through an example of how to analyze a pattern from start to finish. Let us look at the bullish flag pattern. First, you need to identify a strong uptrend leading into the flag. Next, you want to look for a period where the price moves sideways or slightly down. This forms the flag part of the pattern. Once you have spotted this, wait for the price to break out of the flag. You also need to confirm the breakout with increased volume. Your entry point is just above the breakout level. For your stop loss, you will want to set it below the bottom of the flag. To figure out your profit target, you can use the height of the flagpole to estimate how far the price might rise. Another example is the double top reversal pattern. First, you will look for two peaks at about the same price level after an uptrend. Then you want to watch for the price to break below the support level between the two peaks. Make sure to confirm the move with volume. Your entry point would be below the support level, and your stop loss should be set just above the second peak. So to sum it all up, analyzing chart patterns involves several key steps, and being thorough is crucial for successful trading. First, identify the specific pattern you are dealing with. Recognize whether it is a reversal or continuation pattern, as this will guide your strategy. Common patterns include head and shoulders, double tops and bottoms, triangles, flags, pennants, and wedges. Each has its own set of characteristics and implications for price movement. Next, understand the trend that is in place before the pattern formed. Is the market trending upward, downward, or sideways? This context will help you understand whether the pattern is indicating a trend reversal or a continuation. Always evaluate the broader market conditions, as the larger trend plays a significant role in confirming the direction indicated by the pattern. Then confirm the pattern with volume. Volume is an important indicator of the reliability of a pattern. High volume during a breakout suggests strength and reliability, while low volume can be a red flag. Confirming the pattern with increased volume helps ensure you are not reacting to a false signal. Pay attention to divergences as well, such as when price movement is not supported by corresponding volume changes. This can indicate that the price move lacks momentum and may reverse. After confirming the pattern with volume, determine your entry and exit points. For continuation patterns such as flags or triangles, entering at the breakout level is often ideal. For reversal patterns like head and shoulders, entering when the price breaks a key support or resistance level, such as the neckline, is crucial. Do not forget to establish a stop loss to protect against unexpected moves. Placing the stop loss just beyond a support or resistance level can help manage your risk without being overly sensitive to regular market fluctuations. Finally, use technical indicators to support your analysis. Moving averages are useful to confirm trends. The relative strength index can help determine if a stock is overbought or oversold, providing insight into whether a reversal might occur. Bollinger Bands can show the significance of price moves by indicating volatility. For instance, if a price breaks out and moves beyond the Bollinger Bands, this can indicate strong momentum in that direction. Combining these indicators with the chart pattern helps increase the accuracy of your analysis and build more confidence in your decisions. Keep in mind a few key tips. Always wait for confirmation. Do not forget to consider the overall market trend and always set stop losses to manage your risk. Analyzing chart patterns takes practice. It is not something you will master overnight, but once you understand the process, it becomes a powerful tool in your trading strategy. The more you practice, the better you will get at spotting patterns and turning them into trading opportunities. Keep practicing, stay patient, and soon enough you will be analyzing chart patterns with confidence and finding opportunities like a pro. Stay engaged, ask questions, and share what you are learning with others. The more you discuss and think through these ideas, the better you will understand them. Good luck and happy trading.